We're coming to you with a breaking investigation. Over the last 24 hours, the silver market has just gone through a collapse of historic proportions. But you know what? The story you're being told, it's just the beginning. We're about to show you what really happened. So get this, it all went down in just one single 24-hour period. The price of silver didn't just drop, it absolutely cratered, falling by over a third. To put that in perspective for you, this was silver's worst day in 44 years. This is a true black swan event, the kind of thing that's so rare, so out of the blue, it's considered almost impossible. And this wasn't just about silver, not by a long shot. The shockwave from this thing just ripped through the entire market, wiping out an estimated $3 trillion in value. That's like half the annual GDP of the United States, just gone, poof, in a single day. So what on earth happened? Well, if you were watching the mainstream financial news, you got a very neat, very tidy explanation handed to you on a silver platter, no pun intended. Let's take a look at the official story that started making the rounds almost immediately. So the story they're selling us goes something like this. The White House nominated Kevin Walsh, who's known as a monetary hawk. Now, a hawk is just someone who likes to raise interest rates to fight inflation. And that simple announcement supposedly signaled that the party was over, that the era of easy money had come to an end. This, in theory, makes the dollar stronger, and that makes things like precious metals less attractive. See, the market was in what's known as a crowded trade. That's just a fancy way of saying everybody was betting on silver to go up, which made the whole situation really fragile. So this Fed news comes out, it acts as the catalyst, the dollar surges, and boom, it triggers this massive wave of automated selling as everyone just sprints for the exit at the exact same time. It's a plausible story, maybe a little too plausible, but is it the real story? We started digging, and what we found suggests that the whole Fed nomination thing, that might have just been the perfect cover for a much more deliberate, much more engineered event. So let's follow the trail, because as the market was in a free fall, a whole series of other things were unfolding in the background, all at the same time. You can call them coincidences if you want, but when you start to line them all up, well, a very different picture starts to emerge. Okay, check this out. First, public data shows that JP Morgan closed out its massive bet against silver at the perfect, most profitable moment. We're talking the literal bottom tick of the market. Now, as that's happening, two of the biggest trading hubs suddenly go dark. The London Metal Exchange, its systems mysteriously fail. HSBC, another huge player, their systems go down too. And then the final move, the real kicker, the Chicago Exchange, COMEX suddenly jacks up the cost for traders to even hold their positions. Any one of these is weird. All of them together, that's a pattern. And as if that wasn't enough chaos, on top of everything, a fake news report gets pushed out at the perfect time, claiming the US was pulling its support for strategic metals. It got so bad the government itself had to come out and formally deny it, calling the story deliberately misleading. So you have to ask, who benefits from creating this much panic at this exact moment? To really understand what happened, you've got to look past the headlines and focus on the actual mechanism. The financial weapon, if you will, that our investigation shows was used to force the market's hand. You see, it all comes down to this one little thing called a margin requirement. The easiest way to think about it is like a security deposit a trader has to put down to make a really big bet. But here's the critical detail, and this is absolutely crucial. The exchange can change that deposit requirement whenever they want, instantly, with the push of a button. And this is the trap. When the exchange suddenly and aggressively hikes those margins, traders are faced with an impossible choice. Either you find a ton of extra cash to add to your account right now, or you're forced to sell your position immediately. But here's the thing, most of these traders were already leveraged up to their eyeballs. They had no more cash to give. Selling wasn't a choice. It was the only option they had left. So you see, this isn't just random market panic. No way. This is a targeted action. One trader gets forced to sell, which pushes the price down just enough to trigger the next trader's margin call, forcing them to sell, which pushes the price down even more. It's a domino effect, a vicious, manufactured downward spiral designed for one purpose and one purpose only, to completely flush out anyone betting on higher prices. And here's what might be the most damning part of this whole investigation. This isn't some new, clever tactic. When we looked back, we found a clear pattern. A playbook, really, that has been used over and over and over again to smash the silver market at the most critical moments. I mean, just look at the history here. Go all the way back to 1980, they changed the rules to crush the Hunt brothers. Fast forward to 2011, a big silver rally is gaining steam, and boom, they hike margins 5 times in a couple of weeks, killing the rally. Just last year, they pulled the same move during quiet holiday trading. And now today, we see the exact same weapon, a sudden margin hike, used under the cover of some Fed news to engineer this massive crash. The pattern, it's undeniable. When you see the pattern, you realize this isn't some kind of market failure. For the people who really understand how this game is played, this isn't a bug in the system, it's a feature. It's a mechanism that has been used for decades to control the price and let insiders walk away with enormous profits. So this brings us to the final and honestly the most important piece of this whole puzzle. Because to really understand the motive here, you have to get one thing straight. There isn't just one silver market. There are two. And right now, they're telling completely different stories. That crash that we've been talking about, the whole thing happened entirely in the paper market. That's the world of futures contracts, which are basically just digital promises for silver, all driven by leverage and speculation. But then you have the physical market, where people trade actual real bars and coins. And the story there, it's the complete opposite. A massive ongoing shortage of supply. And you don't have to take my word for it. The proof of this disconnect is right here in the data. Just look. In a key physical hub like Shanghai, real silver is trading at a staggering 40% premium over the crashed paper price. Think about what that means. The paper market is screaming that silver is cheap, while the physical market is screaming that it's so scarce you have to pay a fortune to get your hands on it. So why? Why engineer this whole thing? The motive seems pretty clear when you follow the money. A number of large commercial banks were holding enormous short positions. They were betting big that the price of silver would fall, but it kept going up, and they were staring down the barrel of catastrophic losses. This whole event, it was their get-out-of-jail-free card. It allowed them to force the price down, get out of their losing bets with huge profits, and completely reset the game board. Which leaves all of us with one final critical question. The paper market has been reset. The big players have cashed in. But that underlying physical shortage, that hasn't gone anywhere. So as the dust settles on this manipulated crash, you have to wonder, is the real silver story, the one driven by actual supply and demand, only just beginning?